private equity is unbelievably good at making money. The leveraged buyout and the PE playbook is a tried and true formula to triple your money in 5 years. There's been a lot of great coverage on YouTube recently about private equity, and we know that the system is broken. Employees, customers, and even the company itself can all be worse off after PE gets involved. But what's missing from all these videos is the perspective of someone who has actually worked in private equity, as well as whether or not the current system can be changed, and if so, how we might possibly begin going about fixing it. Before we can fix something, we have to understand how it works. So in today's video, I want to bring you on an insider look at how private equity funds actually operate, the mechanics of a leveraged buyout, the tactics used to maximize financial returns, the harm that often follows from these practices, and finally, how this broken system could be changed for the better. Hello friends, my name is Kevin Yang. I spent the last 7 years working across Wall Street and Silicon Valley in investment banking, private equity, venture capital, and impact investing after graduating from business school at the University of Michigan as valedictorian of my class. I fundamentally believe that finance and business can and should be a force for good. So let's get into it. Let's start by covering some private equity fund basics. We'll cover its investment strategy, the GP and LP fund structure, as well as the PE business model. So defining private equity. Anytime you hear equity in terms of finance, I want you to immediately think ownership. Equity equals ownership. Private is the opposite of public. So when you think about public equities, you think about the stock market, right? You buy a single share in a company, you own a little bit of Disney or IBM or whatever. So private equity is an ownership stake in any private company. Because of that, PE is a very broad umbrella term that includes things like venture capital when you're taking a private stake in a very early stage company. But when people talk about PE, they almost always mean the late stage buyout private equity. And that's the investment strategy. It's a buyout. You are purchasing 100% of a company in most cases, at minimum 51%, and you are investing in a very targeted and focused portfolio. You might only have 10 investments for a fund, compared to say an index fund that might be invested across 300, 500 plus different companies. So you're going to buy this company and you're going to have a holding period of typically 5 years, maybe 3 on the short side, 7 on the long side. And it's going to have an ideal profile. The most important things is that it's generating cash and that it's in a stable, mature, and predictable industry. Other things that are beneficial include things like a high quality of revenue, like you have really good line of sight and visibility to contracted revenue that's coming in. You have a good management team, you have low investment needs in the business, and you have a lot of assets that you can secure and borrow debt against. Let's get into the GP and LP fund structure before we dive into the business model. LP stands for limited partner. GP stands for general partner. The general partner is the PE firm and the PE fund itself, its investment professionals. Whereas the limited partner are the institutional investors that are contributing money to the general partner for it to invest in the different companies. So limited partners, institutional investors, that could look like a pension fund, endowments, insurance companies, other large financial firms that have fund of funds, maybe sometimes even ultra high net worth individuals is who you're fundraising from. They're called limited partners because they are limited in their decision-making capability. That investment decision-making goes down to the general partner. But you have rules that they set forth in a limited partnership agreement, like what you can and can't invest in, what fee structures are, what information rights they have, whether there's minimum return thresholds, and so on and so forth. So basically, the important thing to note here is that the general partner reports to the limited partner. You want to make your LPs happy as your customer. And what makes them happy is financial returns. Because after you deploy this fund, you are going to raise typically a next fund, a larger fund, such that you can have LPs participate again and you can keep on making more money. So how does PE make money? Let's say in this example, you have a $300 million fund that you're able to fundraise from your LPs. Your goal is to 2.5 times your money, 2.5x your money, and turn this $300 million into $750 million. Now the fee structure, this is pretty common across lots of different fund types, is something called 2 and 20. This 2% refers to a management fee that the general partners charge the limited partners to basically go about and cover their day-to-day operations. So this is overhead, salaries, rent, travel, what you pay lawyers and accountants, any software subscriptions that you might need. For the most part, your day-to-day. Some of the excess might go into the PE fund's pockets, but for the most part, it's allocated here. So for a $300 million fund, that is a $6 million annual fee. The bigger part of the economics is 20. This 20% is a carried interest. And carry is basically a fancy word to say a share of the profits. So once this PE firm turns $300 million to $750 million, the fund has made $450 million. Not all of this goes back to the limited partner. They have this carry set up such that everybody's aligned and on the same page. So this $450 million, the GP is going to take 20% of that as carry. That's going to be $90 million in carry. Now note, this carry is not taxed as ordinary income for investment professionals, but is rather taxed at the long-term capital gains rate. We'll come back to this more later. And if, look, $90 million sounds like a lot and it's very lucrative, it's because it is. For a fund that's about $300 million in size, they might only have maybe like 8 investment professionals or so. And $300 million is actually a very small fund in private equity. Most people would probably call this lower middle market, whereas on the opposite side of the spectrum, you have your mega funds that are $10 billion plus in size. This is your Carlyle, Apollo, KKR, and TPGs of the world. So how do you actually make this $450 million? Let's talk about the leverage buyout. Whenever you hear the word leverage in finance, I want you to think debt. Leverage equals debt. And then buyout, you're acquiring 100% control of a company, typically at minimum 51%. So there's 3 stages to a leverage buyout. The first is your acquisition, specifically your acquisition with leverage. Next, you have your holding period. And during this holding period, typically 5 years, you're going to be paying down debt. Lastly, you are going to exit your investment. So let's take an example here where at acquisition, we're looking at a company that is worth a valuation, I'm going to say is $100 million. Do this in blue, actually. Now, if you're the PE firm, you can acquire this company for $100 million in your cash. But if you're the $300 million fund that we talked about in our last example, then you'd only be able to make 3 investments. So that's not going to work. So what you're going to do instead is you're going to lever up or borrow money. This is taking on debt at the company in order to finance this acquisition. So I take on debt at the company. In this example, it'll be $70 million with the promise of I'll take on this debt and I will pay it back at a later date. And for the cost of letting me borrow this money up front, I'll pay you interest over time. So generally with the PE firm, you want to take on as much debt as possible at the acquisition. Why? Because it limits and minimizes the amount of equity that you need to put in yourself, which is going to be $30 million for the fund, the remainder of this $100 million company. And what leverage does in an LBO is that it magnifies returns. Similar to the physics concept, using leverage can magnify the impact of a small piece of force or equity that you put in. More leverage means higher returns. So let's get into our holding period. But before we can figure out how much debt we pay down, let's put some numbers behind it. Let's say this company every single year is going to do $80 million in revenue. And for EBITDA, or profitability metric, we're going to say it does $10 million in EBITDA annually. So EBITDA technically stands for earnings before interest, taxes, depreciation, and amortization. But you can generally think of EBITDA as a proxy for cash flow. So if you hear EBITDA, think cash generated. This EBITDA for this company, 10 over 80 is going to be an EBITDA margin of 12.5%. Or if you're looking at a valuation of 100 million, it's a 10x valuation multiple, EV to EBITDA. Now, for simplicity's sake, in this holding period, we have year 1, 2, 3, 4, and 5. We know our EBITDA is $10 million. For simplicity's sake, we're going to say years 1 through 5 are all the exact same in our situation, just for the purposes of this example. The debt, we have to figure out what the interest rate is. This, for simplicity of numbers, I'm going to say the rate is 5%. So my interest expense off the principal of $70 million is going to be $3.5 million. Now, I'm going to call out a note here that 5% is a very low interest rate, and it's not something you're going to see in 2025. This might be something that you saw a little more likely or closer to before 2022, when we were in a really long period of extremely low interest rates where borrowing money was super cheap. Anyways, EBITDA $10 million, interest expense of $3.5 million. I'm going to round here and say that my debt pay down that happens each year is $6 million. Now, I'm going to say this happens for years 1 through 5. And again, this is a simplification. It's a little bit of rounding. In year 1, your taxes is not likely to be, only $500K, as good as PE firms are at limiting their tax liabilities. But it's a fair assumption, I think, because your interest expense, as you pay down debt over time, this is actually going to be decreasing. So let's just say $6 million of debt pay down every year. So in year 1, that's $6 million. Year 2, year 3, year 4, and year 5. $6 million. And effectively what happens is when you're paying down debt, you are increasing the value of your equity. So let's get to the end of the holding period. We're looking at our exit. This might look like taking the company public via IPO. This might look like selling to a corporate strategic buyer who has interest in this company. Or it could also look like selling this to another private equity firm. So we're going to say that we exited at the same valuation we came at, $100 million. But the thing that's changed now and looks different at the company is the capital stack, the combination of debt and equity. Let's calculate our debt first. If we started with $70 million in principal, and over the course of 5 years, we paid off collectively $30 million, then our remaining debt balance is going to be $40 million. And in this capital structure, what's not debt is going to be your equity. And that equity, what we have here, is $60 million. So now we have these two entry and exiting equity numbers. Now we can take a look and calculate our returns. The main metric that PE looks at is something called the MOM, or the multiple of money. How much money came out versus how much money I put in, right? So 60 over 30 is you have generated a 2x MOM. You have doubled your money in 5 years. If you think better in percentage returns, this translates to an IRR, or internal rate of return, of 15%. Meaning if you started with $30 million, you generated 15% return, and this compounded over 5 years, you would end up with double your money. But here's the one thing I really want you to take away from this section. The thesis you need to prove in PE is stability. Meaning you don't have to believe that the company is going to be more valuable over time. You don't have to believe that the company is going to grow in revenue over time. And you don't even have to believe that you're going to improve profitability over time by cutting costs. Literally everything could stay the exact same. You change nothing. But by levering up with debt, you have manufactured yourself a pretty hefty return. And that's why PE is often called financial engineering. But here's the really crazy thing, is that a 2x return, doubling your money in 5 years, is actually kind of considered a bit of a lackluster return. PE firms typically need to underwrite to or have a belief in that they can get 2.5 times their money in 5 years, or even triple their money in 5 years, which would be a 25% IRR. So how do you go about generating higher and higher returns? Before we get into the transactional and operational tactics that PE uses to maximize returns, I want to re-emphasize this concept of buyout. The PE firm is taking a 100% ownership stake in the company. You are its sole owner. At minimum, you can be a 51% majority owner, but in any case, you still have all the voting rights. And because you have 100% of the company, you have complete decision-making control over what happens. The new board of directors at the company are basically people from the PE firm's deal team. And so you can do whatever you want with this company. You can choose to replace the existing CEO and put in your own CEO. You can choose to make hirings. You can choose to make firings. You can choose to open or close new lines of businesses. Private equity is a control investment, and that's really unique. No other investment style is like this. So how do you maximize returns? It is all about cash generation. What comes into the business, what goes out of the business. Cash is king. Here are the 5 primary levers. 1, your transaction terms. 2, your organic revenue growth. 3, your inorganic revenue growth. 4, cost cutting. And 5, a category I call extraction. These are unique and creative structures that private equity utilizes to squeeze out profits where they can. The first one, transaction terms, is pretty straightforward. You want to negotiate as beneficial terms for yourself as you can, right? That means buying something for cheaper or lower, exiting an investment for more, taking on more debt and having more leverage, and getting a cheaper interest rate on that debt. Growing revenue. You can do this either organically or inorganically. Inorganic revenue growth is revenue growth through mergers and acquisitions. If your portfolio company acquires another company, it appends that revenue. That's inorganic revenue growth. Whereas organic revenue growth is just the revenue growth that happens solely at the company itself. So how do you go about increasing revenue organically? Your simple formula for revenue is going to be price times quantity. So to increase revenue, you either have to sell more or you have to charge more for what you currently sell. Now here's a question. If you're tasked with increasing revenue by 10% as efficiently as possible, what would you rather do? Sell more or charge more? This depends on a lot of things like your customer base, the pricing power you have, and your sales cycle. But P's preferred method by far and away is price increases. Because in order to increase quantity, you have to go through the whole sales motion, right? And that is finding customers, advertising, generating leads, doing product demos, contracting, doing research for new markets to expand into. And all of this is time consuming and it costs money. On the other hand, if you instead choose to raise prices, all you have to do is raise the price. And you might say, like, hold on a second. If you raise prices, you risk losing customers and decreasing your revenue, to which I'd say you are absolutely correct, which is why we need to talk about the microeconomics concept of demand elasticity. So let's do some microecon 101. Let's chart a demand curve. Your price is going to be on your y-axis and your quantity is going to be on your x-axis. Your demand curve is downward sloping, looks like this, which basically says, oh, at a higher price, I'm willing to buy fewer things. At a lower price, I'm willing to buy more of it. Now, the demand curve doesn't always look like this. You could have a demand curve that is flatter, or what we will call an elastic demand curve. Elastic demand curves basically say you're very price sensitive. So if I increase prices from a certain given point, you're going to have a really big drop off in the quantity that you sell. On the other hand, you could have a very, and particularly inelastic demand curve. This is steeper vertical. Inelastic demand curves are not price sensitive at all. Because if you increase price, there's going to be a very low drop off in the quantity that you are selling. Examples of products that have inelastic demand curves are things like medication, healthcare treatments like kidney dialysis, vet visits for your pet. And so if you have a company that has a more inelastic demand curve, private equity is especially interested in raising prices to increase revenue. You can see, especially in healthcare, where I'm going with this. Inorganic revenue growth is all about mergers and acquisitions. And when it comes to M&A, do not say the M word, monopoly. There are plenty of good reasons why a business might want to conduct and strategically pursue M&A. Maybe it is expanding a product portfolio. Maybe it's launching into a new geographic market. It could be vertically integrating their value chain, or it could just be market consolidation. Maybe you have a portfolio company and you can acquire another major competitor, or there's also PE firms that literally specialize in a roll-up thesis, and they might make upwards of 30 plus smaller tuck-in or add-on acquisitions over the course of a 5-year period. The key idea here is that when you consolidate through M&A, you increase your market share and in turn you increase your pricing power because customers have fewer options and alternatives to evaluate or shop around at. So imagine you live in a town that has 5 gas stations with 5 different owners. If suddenly they're all consolidated and it has one owner or two owners, you can definitely expect that you're probably going to be paying more on gas. Now, the execution playbook for M&A revolves around everyone's least favorite corporate buzzword, synergies. There's revenue synergies and there's cost synergies. Revenue synergies you can think of as cross-selling. So if company one and company two combine and they both sell product A, but company one sells product B while company two does not, company one can now sell product B into company two's customers. Revenue synergies with a thesis that is really sound and actually proves out is a lot rarer to find in M&A. So the norm is really all about cost synergies, which leads us into our next section about cost cutting. So of all the tactics that we've talked about, cost cutting is by far and away the number one favorite tactic for private equity to maximize returns. Let me show you why. We'll talk about it standalone as well as in the context of M&A cost synergies. Take a basic P&L statement that says, if we start with revenue, you're going to then have the cost of your goods sold, COGS. We'll subtract that. COGS examples, let's say you're a potato chip manufacturer. This is the cost of your potatoes, oil, packaging, and the time and labor that's spent to go into making those potato chips. This will get us to our gross profit. And then we have costs like operating expenses, which I'll label here as OpEx. And that will bring us down to some profitability metric. I'll put EBITDA for now. OpEx, operating expenditures, is everything else, includes things like rent, salaries, benefits, marketing, research and development, office supplies, software, paying lawyers, paying accountants, so on and so forth. Now here's a question for you. To maximize profits, would a business rather have $100 more in revenue or $100 less in costs? And the answer is you'd rather decrease costs. Because if you have more revenue, you have to deliver that product or service, and that has costs associated with it. So depending on a company's gross profit and the split of fixed versus variable costs in their OpEx, that $100 increase in revenue might only turn into, say, $30 more in profitability, maybe $50, $70 would be really excellent, right? And all that, it takes time to sell and deliver. But on the other hand, if I decrease any cost by $100, all $100 goes to improve my profitability. And that impact is immediate, that impact is today. So what cost does PE look to cut? Anything and everything. Every single expense and every single line item gets evaluated with a fine-tooth comb. And even things as small as what kind of printer paper is in the office is on the table. Your biggest expense for most businesses is going to be headcount. That's your salaries, that's your benefits for your people. And if the company you work for is bought by private equity, more likely than not, you can expect that layoffs are coming. Headcount cost reductions could also look like offshoring to cheaper talent pools. Maybe instead of paying a senior software engineer $250K plus in San Francisco, you can find similar talent in Eastern Europe or South Asia for maybe $75K. COGS, if you're the potato chip manufacturer, maybe you switch from using a nice avocado oil to a cheaper vegetable oil. And then R&D is another big category. So a common tactic PE uses is to decrease R&D at the outset of the investment, and then in the 2 to 3 years before it gets sold again, to start increasing and ramping back R&D such that it looks like R&D spending has been increasing over time. In the context of M&A, PE loves to salivate over cost synergies. And the most common cost synergy, and it might as well be synonymous one-to-one, is layoffs, particularly in back office roles and overhead functions. Things like HR, accounting, legal, compliance, IT, even management teams. Because when you combine two companies, you suddenly have two of each of these departments. You have two HR teams, you have two accounting teams, two legal teams, you have two CEOs, two COOs, two CFOs, and these are duplicative roles. You don't need to, so layoffs are coming. And that's the basis for cost synergies. Now, the through line with cost cutting in PE is that you put as much pressure on everything as you possibly can without things breaking. You bring everything just up to that breaking point. Your teams and your departments, they might be understaffed and thinly spread, overworked, but if things didn't break, that's okay. And for customers, They'll take the perspective that your customers don't have to love you. They just have to like you enough to be willing to pay you. That's the mentality. You cut costs, you generate more cash, you pay down more debt, you increase the value of your equity, and that gets you a return on investment. Let's move on to our last category, which is extraction. It's a bit of a bonus and catch-all category, but I want to walk you through dividend recaps, sale leasebacks, and PortCo management fees. You're not going to see this in the majority of all PE investments, but what I want to illustrate is that wherever PE investment professionals can find a creative structure to boost their returns, even if it's at the expense of a portfolio company's long-term health, they will do so. So a dividend recap. Let's start with dividends. A dividend is when a company has excess cash on its balance sheet. It's already spent the cash that it needs to invest in its business, and it'll take that excess cash and distribute it as a dividend to shareholders. If you're in the stock markets, you've probably received one yourself. Now, capitalization. Capitalization is basically a fancy word for saying how much debt and equity is in your business. And a recapitalization in that case is just a change in debt and equity. So a dividend recap is where a PE firm in the middle of their holding period is going to take on additional debt at the company and use the entirety of these cash proceeds from the debt and distributing it as a dividend to its shareholders, which would be the PE firm. So the investors receive the cash while the company has interest payments to make. And so at first it's like, whoa, can they do that? And the answer is it's unsavory, but it is absolutely legal. And this goes back to buyout and control because the PE is the sole owner of the firm and they have decision-making power. Who's going to tell them not to? The next category that we have is a sale leaseback. A sale leaseback is when you take an asset that a company owns, take for example, an office building or property, and you sell it to a third-party owner with the intention of leasing it back from that new owner. So effectively, you're switching from ownership of an asset to renting that asset. And this might happen even if it's not in the long-term interest of the company. Maybe that company plans to use that office building for many more years ahead. But this transaction happens because you get that big cash influx from the sale of the asset. And cash is king. Lastly, we need to talk about management fees. These are not the type of management fees that we mentioned earlier that the LP pays to the GP for operating the fund. These are management fees that the private equity firm charges its portfolio companies for things like oversight, operational assistance, or transactional advisory. And these are a little arbitrary in nature. The PE firm is directing particular actions to be taken, as the owner of a business does, but it is then charging the portfolio company at a rate set by the PE firm and agreed to by the portfolio company because the board is the PE firm. And while the PE firm might provide some really excellent, transactional or operational advice, I argue that that's the normal course responsibility of a business owner to do so. And so with management fees, money comes out of the company and becomes a revenue source to support the profitability of the PE firm. Notably, it does not go to any of the limited partners. Underlying all these creative structures is that at the outset, private equity has an exit date in mind for the investment. It's a short-term view. You only care about the company insofar as it exists during your holding period. Anything that happens afterwards is not your problem. Now, if I was just seeking to earn a financial return, I'd put my money into PE. I think it's an excellent investment class. The people who work in PE, and especially those who stay till seniority, are very smart, very hardworking, and care a lot about getting paid. They get paid by generating returns, either by extracting value or creating value. And it's easier to extract value than it is to create value. So PE firms and limited partners are clear beneficiaries here from all these actions. But what about everybody else? What harm is created by private equity in their pursuit of maximum returns? I'll break things down into three categories of stakeholders that are worse off from PE. Number one, employees. Number two, customers. And number three, the company itself and the broader community. Employees at a PE-owned company, unfortunately, really get the short end of the stick here. There's a lot of worker displacement because the PE firms come in with the intention of layoffs and offshoring. And even though there's a lot of thought that goes into reducing the headcount, it's not typically done with much care. So PE firms look at human capital as any other resource. It's a productive use to make money. And I think sometimes they forget that there's an individual on the other side of these decisions. When you're in the final stages of a PE diligence process, you're going to go through a file called the census, which is basically an employee database that has everything about them from salaries, benefits, locations, department, and reporting structures. Names are blinded for privacy, and so you're literally just looking at employee ID numbers, and you're going to go through the census and you're literally tagging ones and zeros of who gets to stay and who has to go. Now look, I'm not saying that layoffs are inherently a bad thing, but when layoffs aren't done with care, there's a real emotional burden that comes alongside of it. So think about employee engagement. Morale is terrible after a layoff. And then to add insult to injury, the survivors are rewarded with a heavier workload. Because remember, PE cost cutting is about pushing things just before the point of breaking. Teams are overworked and they're stretched thin. And PE doesn't want to pay more for anything than they absolutely have to because they're trying to preserve cash. So your raises, the promotions, the bonuses, everything's kind of kept tight. There's this complete erosion of workplace culture. And all of this taken together it's quite sad. I was once at dinner with a group of friends who we all worked in PE, and I tossed out the question, would you ever work for a company that's owned by PE? And the immediate and resounding answer was absolutely not. Customers are worse off after PE gets involved. We've talked about price hikes. You're going to be paying more for whatever you're already paying for. And we've talked about cost cutting. So whatever product or service you're getting isn't as great as it was before. The most prominent example, I think, is in the healthcare industry, specifically in nursing facilities. A few years ago, researchers at UPenn and NYU evaluated Medicare and Medicaid data of more than 18,000 US nursing homes across the US over a 15-year time frame, and found that after a nursing home was acquired by a private equity firm, there was a jump in the short-term mortality rate by 10%. Maximizing returns through the PE playbook can literally result in death. And that is outrageous, right? Good luck to you, your parents, your grandparents, if the only nursing facility in your area happens to be owned by private equity. Let's talk about how the company itself is worse off before getting to the community. Because PE takes such a short-term view, the company's long-term health is going to suffer. We talked about the extractive tactics. The cash that could have been reinvested into the business is now going to its investors. When R&D gets cut, that is literally a reduction in innovation. This limits the company's future growth prospects of putting out new product lines or improving services. And it's bad for customers too, right? I literally don't know what innovation I'm missing out on. Now for the community, the broader community can suffer mostly through the lens of bankruptcies, right? When you put on a lot of debt at the company, there's this inherent risk of bankruptcy. Maybe things don't go as planned, you can't service your interest expense, the company defaults and becomes insolvent, and the lenders take over the company in a bankruptcy. This causes a lot of uncertainty over what might happen next. So maybe the lenders try to recoup their investment and they choose to completely discontinue operations and sell off all of the assets. Now, for critical industries like healthcare, education, housing, and infrastructure, that bankruptcy and that discontinuation of operations can suddenly create a pretty painful void for a region or a community where these services are no longer going to exist. When PE puts so much leverage onto a company, PE is introducing a systemic risk that wasn't there before for society. Alternatively, in a bankruptcy, maybe the company might reemerge out of bankruptcy after it gets its liabilities restructured, or maybe the lenders take over and sell it to another company. Now, in a particularly egregious example that combines both, back in 2007, Sun Capital acquired Friendly's. It's an ice cream and diner chain. This PE firm counterintuitively pushed the company towards bankruptcy. It wanted to restructure its liabilities and shed a $100 million pension obligation that it had on its balance sheet. Now, this structure was unique and could only happen because Sun Capital owned the equity of the business through its private equity arms, but through another investing division also owned the debt of the company. So when it entered into bankruptcy, the lenders claimed control and went from one department of Sun Capital into another. And during that bankruptcy period, it restructured its liabilities, namely it shed its $100 million pension liability. And then Sun Capital reacquired this business, now free of a pension liability. What ended up happening to that pension obligation, right? Like pensioners need to be able to retire. The pension liability was ultimately picked up by the Pension Benefit Guaranty Corporation. This is sort of like a quasi-government entity that pension funds all contribute to into almost like an insurance pool. So who is left to pick up the tab for this is other responsible pension fund managers, while PE walked away with the same business now without pension liabilities. Whew. So PE firms don't really want a bankruptcy on their hands, right? They want to preserve their capital. It's not in their interests. But when a bankruptcy does happen, the PE firm only risks the capital that they put in, that 1x of their capital. That's a tenth of their investment fund. And you can recoup this by having another investment overperform. Bankruptcy isn't ideal for PE, but it's not that painful. They're able to walk away. And it's really the community that's left holding the bag and that's left to suffer. So what can we do to mitigate this harm? Admittedly, this is challenging because there are very few parties or groups that can actually exert any influence over a PE group's actions. It's the government through policy and regulation, it's limited partners because they're the customer, and it's the PE firm itself. But here are 5 ways that we can start repairing this broken system. Number 1, PE firms should be held legally responsible for the actions of their portfolio companies. Leveraged buyouts have very complex ownership structures that involve intermediary fund entities and shell corporations that ultimately own the portfolio company. And it's intentionally designed this way to distance and limit the PE fund from the legal liabilities of the portfolio company. As we said, when a portfolio company goes bankrupt, they're bankrupt, but the PE firm, all they risked was 1x their investment capital. So here's another real example from the nursing home industry. Carlisle acquired a nursing facility, ran the typical PE playbook, and floors were understaffed. There is a patient who typically needs assistance to go to the bathroom, but doesn't have anyone available to help, so she tries going herself. Unfortunately, she falls, she hits her head, suffers from brain bleeding, and passes away. The family of the patient sues the PE firm for wrongful death, but Carlisle is able to successfully argue in court that they are actually not the owner of this nursing facility. Instead, they merely advised these intermediary funds that are the real owners through the shell corporations of the nursing facility. So despite a PE fund having complete control to dictate a company's actions, and it stands to benefit from its profits, when things go wrong, they hold no legal liability and are able to walk away. If PE firms were held legally responsible for the actions of their portfolio companies, they might think twice about how they go about business. Our next item related to policy is that we should close the carried interest tax loophole. Remember, carry is the 20% cut that the general partner takes of the investment fund's profits. This is the main revenue source for a PE fund's business model, and it's the main income source for an investment professional working at a PE fund. And right now, carried interest is taxed not as ordinary income, but rather as a long-term capital gain. Long-term just means an investment that's held for more than 1 year. Capital gain just means increase or appreciation of a particular investment. So for most PE managing directors, this capital gains tax rate is 20%. Whereas the ordinary income tax rate that they would be paying is 35 to 37% for the uppermost brackets. Now, if PE is going to be extracting value from these companies, policy might as well make it a little bit less lucrative. And when I say that, I mean PE should pay the same tax rate as every other working professional. Also, the tax revenue is good for the US government, given our $36 trillion debt balance. PE generally flies under the radar of regulation in Washington, D.C., and that's because PE funds spend a lot of money in industry groups for lobbying. And anytime you see big corporates spending big money on lobbying, it's probably a pretty good indicator to ask yourself why. And so we should start by closing the tax loophole on carried interest. Third, LPs need to hold GPs to higher standards. So institutional investors are the capital source for PE to do its work. The GPs and the PE funds do not exist unless the LPs show up at the table. And I wanted to make it really clear to LPs that you are really the only group that PE is willing to report to and should try and make happy because you are the customer. And because PE funds want your money for the next fund as well. Listen, this is especially true for 2025, right? It's a very difficult fundraising environment right now, and LPs have a lot more negotiating leverage over GPs. So what can LPs do? Maybe it's something that is as simple as requiring the PE firms to conduct an ESG or an environmental, social, and governance analysis as part of their final stages of the due diligence process. Yes, ESG has its limitations, and yes, PE firms, for the most part, do not give a flying hoot about ESG. But if you're an LP, I mean, what else is your 2% annual management fee going to, right? It doesn't cost much for a consultant to do a data room review, ask a couple diligence questions. And in the instances that a material risk is actually identified, that is incredibly important information to have for the value of your investment. So for the PE firm, have them start by changing the action, and then you can change the intention. A counter argument to this that an institutional investor might say is like, well, I'm a pension fund and I have a fiduciary duty to my pensioners. And so this work falls outside of that scope. It's not in the realm. But we've seen today that there's harm that can result for a lot of different stakeholders, including the community, including the pensioners, when PE isn't held to a high standard. So by doing this work, I would argue that you are in fact better fulfilling your fiduciary duty to the people that you serve. These last two have to deal with the PE fund itself. Number 4, PE firms should drive LBO over performance with broad-based employee ownership. So it's common industry practice today for PE firms at the time of acquisition to put in place something called the Management Incentive Plan, or the MIP. And this is basically an equity compensation package. Maybe it's a mix of restricted stock units or options. So when the investment is exited, the management might own 5 to 10% of the company and receive a big payday alongside the PE firm when things go well. Here's the thing. Why not extend this to the broader employee base? The same logic of motivation and alignment applies, and you can structure the terms for vesting however you like as well. This is a relatively new thing in the PE ecosystem, and it's not widely practiced today, but thankfully it is being championed by the co-head of global private equity at KKR, Pete Stavros. Pete is doing absolutely excellent work on this. And I think that employee ownership is probably the single biggest lever of change for PE to make within itself and should be an integral part of the PE playbook. What you have to believe is that the equity you give up is worth the upside from higher employee engagement. And I want to be clear to my PE friends. This is not a zero-sum game where if you give employees more, you are going to be left with less. When you put yourself on the same team as your workforce that is now better motivated and you're collectively driving towards a shared vision where everybody gets to participate in the upside, that culture is going to eat strategy for breakfast. And that is going to drive overperformance in your LBO and generate returns. So, putting more employee stock option plans in LBOs. Lastly, the culture in private equity needs to change. And this starts and ends with the people who work in private equity. Look, I don't think that PE is inherently bad. I don't think that the people who work in PE are necessarily evil, and not all PE acquisitions are nightmare situations. Right? I'm sure there's plenty of case study where PE gets involved and employees, customers, and the company itself are all better off because of it. But that's the exception, and it's not the norm, right? The way PE exists today, it opens itself up to unsavory practices and potential abuses of the system. There's a book I first read years ago, just grabbed it off the bookshelf, called The Wisdom of Finance by Mgmt, who is a professor at Harvard Business School and Harvard Law School. Subtitle, Discovering Humanity in the World of Risk and Return. It talks a lot about debt, not in the context of a leveraged buyout, but as a humane financial tool to help somebody achieve more than they otherwise would be able to on their own, right? Maybe this means going off to college to get a degree, or maybe it means buying your own home. Something that was previously out of reach is now in reach because of debt. So I'll pose the question, where's the humanity of finance when it comes to private equity? And here's my message to the very smart folks that are going into private equity out of top business schools and consulting and banking gigs. When you acquire a company, you become a steward of that business. Now, PE doesn't really take the same view of responsibility and ownership that, say, a founder of a startup company might, or even a CEO of a big public corporation might see their business. I mean, PE folks, we're financiers, we're not operators. We spend all day modeling things out in Excel, crunching numbers, and we tend to see things from a spreadsheet and PowerPoint deck's perspective. Where is the duty of care when you step into ownership? I want you to be real with yourself and ask whether or not you can turn a blind eye to what your firm is instructing you to do or what actions your firm is taking. I once had a really good friend and colleague in PE share with me, if my wife knew what I really did at work, our marriage would look very different. All this talk about PE, some might say it's just the ordinary course of business. That's how business is done. But my take, the status quo is never permanent. Let's revisit our initial question. Can private equity be fixed? Yes, it absolutely can be. But the logical follow-up question is, will private equity actually change? If it does, it'll take time and it'll happen slowly. I'm optimistic and I'm hopeful, but I'm also not holding my breath. Hello friends, this is my very first video. I'm creating this channel because I want to help you understand how industries can be reshaped to do better for people, for planet, and for profit. I want to demystify some of the world's most pressing problems, and most importantly, I want to help you break into a meaningful, purpose-driven career, be it in impact investing, social entrepreneurship, or climate and sustainability. So let me know what you want to see more of next, and if you learned something today, please consider subscribing.